Hello, everyone. Welcome to our webinar Wednesday. I'm Michael Tegos, and I'll be your host today as we dive deep into India's logistics sector to take a detailed look at this very dynamic market. For this, I'm very lucky to be joined by two insight providers who tackled this very topic in a recent Smartkarma original insight. Nitin Mangal is a research analyst with more than 10 years of experience in Indian equities, specializing in corporate governance and accounting research in the Indian market. Nitin, welcome to the webinar.
Thanks, Michael. Thanks. Thank you very much.
And Pranav Bhavsar focuses on research on consumer themes and companies operating in India or global companies that have significant exposure to the Indian economy. Pranav, welcome as well.
Thank you, Michael. Thank you for having me here as well.
Before we get started, just a few housekeeping notes. The audience is very welcome to send in questions for our speakers using the Q&A button on your screen. As always, please do not reshare or reproduce the contents of this webinar without express permission. We will have a recording of the webinar available on the registration page afterwards. With that, I'm not going to take any more time. Gentlemen, please get us started.
Yeah, thanks, Michael. So, Indian logistics segment is having a market size of over 20 trillion INR, and this particular segment is expected to grow with a 12% CAGR in next 4 to 5 years. Now, if you look at the Indian logistics segment, it is highly unorganized segment as such, whereby most of the surface and road transport is being run by the local transporters or small time operators. The second highest contribution comes from the warehousing, which is around 25%, and remainder is from the freight and forwarding and the airspace. Now, Government of India has come up with a lot of policies to give a boost to this sector. They are setting up new logistic division. They have started with the multi-model logistic park policy and dedicated freight corridors going forward. Now, what happens in last 2 to 3 years, the sector was expected to grow tremendously because of the implementation of GST. There was a expectation that after GST, the free flow of goods will be there, and there will be a shift from unorganized sector to organized sector. But the government has not implemented the policy properly, and frequent changes in the policy led to the failure, or the sector has not witnessed to see the growth what is expected. Now, during this year, the Geo has launched, they come up with a plan of the retails. And Geo has demonstrated well in the telecom industry with the size of the growth and the market disruption what they have caused. With the size of investment and the Geo has received for the retail from a lot of murky investors from globally, it is expected that this sector is again going to see a fresh hope of life for the next couple of years. Now, what we expect is that, as we have seen in the Geo and telecom industry as well, that overall ARPU has not increased for the telecom industry. Same way, what we expect is that this sector is not going to see a increase in revenue per user, but the penetration level will increase, and like like the users of the internet has gone, the data users has gone up from a minuscule level to around 11 GB. So same way, this is going to help the sector in e-com logistics sector. So now I guess Pranav will take on for the e-com logistics.
Yeah, thank you, Nitin Bhai. So as mentioned, if you look, there are a lot of, in terms of industry, 77% of the Indian express industry is domestic, of which surface is around 71%. And if you look at the B2B market, it is primarily driven by auto and textiles. And the B2C market is predominantly driven by e-commerce. In terms of value, around 43% is captured by line haul and 47% is captured by last mile delivery providers, implying players present in these segments are likely to be the major beneficiaries of the e-commerce boom. Uh, uh, if we talk about some of the key players in the Indian logistics ecosystem, so in surface and air express, we have Blue Dart, Gati, TCI Express, which we'll be diving through during the course of this webinar. We also have a couple of captive e-commerce plays, like Amazon has their own Amazon transportation services, and eCart is owned by Flipkart, which also offers services to third-party providers. For 3PL, third-party logistics, there is a players called TCI. Then we have Mahindra Logistics, Future Supply Chain, some of the prominent ones. And in terms of startups, we have Delivery, Ecom Express, Express Bees, which are well funded by marquee investors. And there are also a couple of global majors like FedEx and UPS, which are present in India. Uh, we did interact with a lot of participants across the ecosystem in order to understand how we can position as investors to benefit from this e-commerce boom. So industry is now looked into with a new perspective and is an important part of overall strategic plan, amplified primarily due to COVID-19. Because of COVID-19, people are looking at logistics in a fresh manner. Earlier, reverse logistics was very painful due to high returns, as majority of the orders were cash on delivery. Some sellers, some sellers that we spoke to also mentioned that customers used to order from multiple platforms and keep the order that is received first and cancel all the other orders. Now that the orders are prepaid, this pain point is gone, which is a big boon for the logistics industry. Technology also is extensively being used both at the warehouse level as well as at the customer end. Amazon, Flipkart, Jio, all are focusing on local shops, which are known as Kirana stores in India, where their ability to provide hyper local deliveries or use these Kirana shops as micro fulfillment centers are expected to be some of the key drivers for the strategy for players like Jio or Jio platforms. The warehouse market, like Nitin Bhai mentioned, is highly fragmented and still it's what we typically call is known as go downs, providing a long runway for growth, especially for organized warehousing. And currently, when we spoke to a couple of participants in the ecosystem, the current demand for warehousing is driven by e-commerce players primarily. And there is still a challenge to find quality warehouse. Quality warehouse as in the one which meets the criteria of location as well as the price. And a lot of industries or even the SMEs and MSMEs we spoke to, they mentioned that they save around 20 to 25% when they use third-party logistic providers. And the key thing that is happening right now is the big boy startups, which startups like Delivery are using disruptive pricing in order to gain revenue, and they are wooing mostly e-commerce sellers with lower prices than the traditional legacy players like Blue Dart or TCI. Most of the e-com platforms have tie-ups with sellers typically, which they typically use for fulfillment. The seller also has an option to fulfill the order via their own sellers, but it's not very preferred. The legacy players in the system continue to be very asset heavy and expensive, but they also have their own space in the market. Say, for instance, Blue Dart is considered like a premium player, and especially even though it's expensive, it's always preferred when the SLAs for delivery, like service level agreements for delivery, are very tight. During the COVID-19, during the peak of lockdown, a lot of demand and a lot of pressure was on these logistic players, primarily driven by huge demand for grocery retail. And what we have been hearing that usually when you are working with an e-commerce customer, the SLAs are very tight, service level agreements are very tight, putting a lot of pressure on the team. And these are low margin business, especially with e-commerce players, which is why the legacy players don't want to get into this part of the game. For Jio, what a lot of e-commerce sellers are expecting is that Jio will have to have a couple of exclusive brand tie-ups, which will lure customers to their platform. And one thing which we have been getting from our interactions is that Indian customer tends to be very value conscious. They will only shop online if they are getting better deals. Most of them prefer value over convenience. So even if Jio is coming up with a hyper local offering, unless it's cheap, people are not going to go for that. They will prefer to go and get their own groceries rather than order online. And a lot of all the big players are wooing the small mom and pop shop called kiranas, but they have their own set of challenges. Say, for instance, if we have to process reverse logistics, returns, having the right mindset, it's not going to be very easy for these players to implement this across this set of the market. Next, so based on our interaction, we feel express logistics, primarily surface players, would be one of the core investment themes that one can explore further. As companies look at the logistic function in a new light because of COVID-19, 3PL players also have a massive tailwind behind them. In terms of the high competition among e-com players, along with some initiatives like GST, which will now start yielding results, warehousing is also expected to remain one of the interesting themes that can be considered over the next couple of years. Companies, as in the e-commerce platforms, will have to compete on service and delivery, where warehousing will play an important role. If you don't have proper warehousing, you will not be able to provide proper service to your customers or new customers. And with Indian warehousing being highly fragmented, the runway for organized players is very, very long. We'll quickly go through some of the company profiles. So in terms of players in the surface place, we have Blue Dart, which is predominantly high into documentation and remains a premium service provider. Gati has a diverse set of offering and has been recently taken over by All Cargo, which is again a holistic logistic player. TCI Express is a dedicated express solutions provider that is focusing on B2B solutions as well as e-commerce space. Other players in the private space are Safe Express and DTTC, which offer similar services. So these are just some operational metrics on how these companies are positioned. So clearly Blue Dart has one of the largest fleet sizes. In terms of capital allocation, Blue Dart and TCI Express both absolutely stand out. When it comes to third-party logistics, there are not many players, many organized large players. So we have Mahindra Logistics, Future Supply Chain Solutions, and TVS Supply Chain Solutions. Mahindra Logistics is one of the largest ones, which has presence in warehousing as well. And in terms of number of fleets also, you can see it has the highest number of fleets, plus it has a decent size warehousing area as well. And the service quality of number of pin codes being served also is very high. In terms of capital allocation, Mahindra is a comfortable double digit compared to Future Solutions, which still is under single digits when we talk about capital allocation. In terms of private players or the startups, they are not really startups, they are very large companies, but typically delivery is backed by SoftBank, and it's been one of the only unicorns in the space. Extremely aggressive pricing, extremely aggressive mode of revenue capture. Then we also have Ecom Express backed by Wowberg, which is again a giant player catering to e-commerce segment. And we have Express Bees, which is backed by Alibaba and Paytm. So those three are the players in the private space. So a couple of operational parameters here. So delivery clearly does a lot of shipments, has a 1 million shipments per day, and is currently the leader in terms of operational volume. So in terms of operational reach, delivery and e-commerce are neck to neck. Ecom Express has higher pin codes and delivery has the highest shipments. If we look at the captive place, we have Amazon Transportation Services and eCart. eCart is now not only for Flipkart, but it offers solutions for other platform providers also. And interesting part about ATS, Amazon Transport, is the only one which is profitable. And profitable, the reason for having profitability is because of good control over cost, which Amazon has been able to do. compared to other players. Now, an interesting private company which is still small, but which we feel is very important in this ecosystem is Grab. It's not the same Grab which is present in the Southeast Asia, but this is Grab Logistics. And just recently, I think a year or so before, 80% of Grab was brought by RIL, that's Reliance Industries, at a valuation of around 165 million. And what we have been seeing, a lot of orders for Reliance Jio and JioMart are also being processed by Grab. So Grab can actually evolve as a captive play for Reliance Jio, but it's still at a very nascent stage. There are a couple of the global majors, FedEx and UPS. They have presence in India, but they are mostly used for outbound and out country documentation and logistics. India Post also is an interesting player. It's been used by both Amazon, Flipkart. All the e-commerce majors also use the India Post ecosystem, but there is still a lot of technological lag for them, and there is no way we can expect any privatization from India Post. Now I'll hand over to Nitin again to just run us through some accounting standards and their impacts on ratios.
Yeah, thanks, Pranav. So, why accounting is important for this logistic industry, especially for the e-com logistic players? Because if you look at the new players compared to the legacy players, so new players are having asset-light model. But when Indian accounting standard adopted the IFRS or converts to IFRS, so because of the Ind AS 116, which is accounting for leases, it has changed the entire dynamics for the balance sheet and the P&L of the companies. So what it has done, so there are a lot of liabilities regarding the leases which remains to be off balance sheet. Now because of this new accounting regulation, now these liabilities has to be recognized in the books of account. So when as compared to the earlier or pre-accounting norm, when your balance sheet or your fixed asset schedule looks lightweighted, it now the companies have to recognize all these assets in the books of account. Secondly, lease rental, what they used to pay normally, was part of your EBITDA. But now what this accounting norm says that you have to divide the liabilities into two parts. One is the depreciation of the assets, what you're going to recognize, and second is the interest payment on the liabilities, what you're going to pay for next 5 to 10 years. So it has done two things. So it has actually impacted the EBITDA in positive way. So if I compare the EBITDA margin for the companies pre this accounting norm and post this accounting norm, my EBITDA margin looks inflated or it looks healthy in that sense. But on the other hand, my PBT margin or profit before tax margin will look lower. And because of this, my debt equity ratio has adversely impacted for these companies. Now, there are two companies which we have seen which from the amongst the listed companies, the Gati and Forensic. Uh, so Gati is having a lot of issues when we look at the balance sheet of this company. So I'll just summarize the issues into 2 3 parts. So we have seen a lot of loans and advances has been given to the related parties and the subsidiaries, and these loans and advances are not recoverable because of the deteriorating health of the promoter-owned companies and the subsidiaries. Despite that, the company has not taken any impairment for these loans and advances as of now. But if going forward, if they are going to take the impairment hit, it is going to wipe out at least 1 or 2 year profitability for this company. Second thing, what we have seen is that there's high amount of contingent liability, including some income tax liability regarding the MAT provisions, which are around 40-45% of the total net worth of this company. So if any unfavorable judgment comes against the company, then it is going to affect the financials in a big way. Now, there's another interesting thing in this company. What we have seen is from the analysis of financial, it looks like that company was aggressively recognizing receivable, or in term, the revenue recognition policy is quite aggressive compared to the other players, which makes the case a little bit uncomfortable while making an investment decision into this company. Second thing, as this company has said, they are amongst the largest player when it comes to the e-com, right? So especially when a lot of people order from Amazon or Flipkart, there's a lot of payment received, which is on the cash on delivery, right? Now, cash on delivery is nothing but it's a liability or the cash collection on behalf of Amazon or Flipkart or some other e-com player. These cash should not be recognized in the books of account as a normal cash and bank balance. It is a restricted cash. But interestingly, this company has not disclosed any amount of COD collection or restricted in its books of account. So if I look at the operating cash flow of this company and the cash balance of this company, it looks overstated to me when compared to the other players. Now, the second company which we find out there's a lot of issues from the forensic analysis angle is a future supply chain. Now, there again the same story of Gati, where a lot of related party transactions happens with this company. So the related party transaction amounts to around 60% of the revenue which they derive from the promoter-owned companies. Now, the interesting observation in this company is there's a absent relationship between the cash and debts of the company. So ideally, cash and debt uh, goes in inverse proportion, right? But in this company, cash is also going up and debt level is also going up. So there's a question of the company why this company is not paying up cash, why this company is not utilizing this cash to repay its debt and uh, remove the burden of the interest cost in the P&L account. Second thing, we have found out that a lot of this cash is still lying in the current account, which is around 120 crore rupees or 1.2 billion INR. Now, as a prudent, this company belongs to the future group, which is and must be having a treasury operation in the place. And if you are putting a lot of money or you are parking a lot of cash in the current account, which is not yielding you any return, which casts doubt on the entire treasury operation of the company and the internal control of the company. So why this cash has not been deployed and why this cash has not been utilized to pay off its debt obligations. If you look at another angle in this company, then it's a fleet size. So if I say the 2019 fleet size, if I say, and from the fixed asset schedule, I try to calculate what is the amount of the gross block they have invested on per truck. It comes around 3.6 lakh rupees, which is quite low. Because if you go in market and go and buy a new truck, it is not going to cost you less than 8 lakh rupees or 10 lakh rupees. Despite that, this company has shown only 3.6 lakh rupees per truck in its books of account. So there's a highly doubt on the fleet size which company disclose in its financial statement against what they are having in the books of account. Yeah, that's it from the forensic angle. So we are clearly saying to if you want to play the logistics sector, then you should avoid these two players, Gati and Future Supply Chain. Yeah, Pranav.
So yeah, in terms of public players which we prefer, we do not wish to comment on the valuation because that's always a subjective argument. But TCI Express is very well positioned because of its strong focus on MSME, that's medium scale enterprises and small scale enterprises, and that too in tier 2, tier 3 cities. So the focus TCI is predominantly a B2B player, and it's not only e-commerce, but it is focusing on both e-commerce, pharmaceuticals, automotives, and also the focus is a little bit higher parcel size, that's 5 kg to 1 ton. So they seem to be well positioned. They have a good balance sheet, and is likely to be one of the least disrupted players by the big boy startups. Second, the preferred play is Blue Dart. First of all, the e-commerce and retail segments have been growing at a pace of around 25-30% for Blue Dart. Around 75% of its revenue still comes from air and the rest comes from surface. And it has 94% revenue coming from institutional clients. So there is a good revenue visibility for Blue Dart. And Blue Dart had also reported a one-off expense due to restructuring and COVID in financial year 20 to the tune of 641 million and 542 million rupees. So the restructured balance sheet would make the return ratios go attractive going forward. And our channel checks also have indicated a strong brand mode for Blue Dart when it comes to meeting in tight SLAs and sending in documents. So Blue Dart is well positioned to play this game. And then in terms of logistics, Mahindra Logistics is the only one that stands out. And there are twin engines for Mahindra Logistics. One, it's high reliance on automotive sector. So if we were to believe that the down cycle in auto is over and it should see an up cycle in the next couple of years, then Mahindra Logistics will benefit both from the auto recovery as well as the e-commerce recovery. If someone wants to write pure play just Geo and Geo's investments, then we feel that public market companies will not be too much of a play for just using the Geo tailwind. So for that, we think delivery is a preferred play. I mean, although they are burning cash, they have good support from investors. So delivery is a preferred play, and also eCart can go through the furthest distance because it is the only company to have significant cash positive in recent 2019 financial year. So Grab also is the one to watch out for, but there is no way we can invest in Grab because 80% is held by Reliance. So these are some of the private plays which can benefit from the Geo tailwind. What can put our broader thesis at risk for this particular sector is, of course, if there's a sharp slowdown in GDP or broader economy, then you don't have any shoppers for this e-commerce boom. So that's one of the larger risks for us. Then there's very high expectations for Geo and its retail ventures. So over the couple of years, if the ventures don't play out and the logistic boom does not come in, so that's one of the key risks for this thesis to play out. And of course, then we have very own company specific risk. Say, for example, delivery can challenge Blue Dart and other segments also. Mahindra Logistics having high dependency on automotive industry can keep the returns muted for a couple of years or couple of times, and then TCI will get impacted if there is high impact on MSME or SME growth. So these are some risks which you should keep in mind. More we have well in our insight, but that's it from us. Back to you, Michael, for questions.
Thank you very much, gentlemen. This has been very enlightening. So I would like to also remind the audience, you can send in your questions using the Q&A button. I wanted to ask regarding the dynamic between the startup players and the more established larger players. So the startups obviously using their venture capital funding and what have you, they're able to offer more competitive pricing, and they're able to capture a lot of market share very quickly. But is there concern that they would burn this cash very quickly, and that the sort of, you know, the tap would be turned off eventually, leaving the larger players to capitalize?
Should I take this, Nitin bhai? Yeah. So see, both of them operate in a different domain. So the larger legacy players, as we call it, you know, Blue Dart and everything, they are not coming and fighting the e-commerce space. So they have left the market open for well-funded startups. And looking at the minuscule market that e-com logistics is right now, at least for the next couple of years, there isn't going to be a situation where the funds stop. The funds start drying up. So there will be a lot of interest. There are already a lot of investors lined up. So I don't see a situation where the startups will be short on cash. And the legacy ones have already given up. They don't want to fight a low margin, low volume space.
Thank you for that, Pranav. So a question from the audience. Are the logistics arms of Amazon and Flipkart able to deliver in tier B, C, and D cities and towns?
Yeah, I think Nitin just answered on the chat. Yes, I mean, in terms of reachability, there's no problem at all. All the players are almost uniform. And a lot of them use each other also. So Amazon does delivery using Express Bs or Amazon transportation services or Grab. All of them have some kind of shared ecosystem.
Another question from the audience is, does it seem at this time that it's better to be asset heavy or asset light for these companies? And perhaps especially for the third party logistics?
Of what our interaction with a lot of supply chain professionals is hinting that, even in logistics, including warehousing and things like that, there is a lot of technology that is coming to play. So they have shared infrastructure, they have cloud warehouses and things like that. So it definitely makes sense to be asset light. There has been some models wherein, say, for instance, Amazon does not want to own the warehouse. It will just take the entire warehouse on operational basis, and it will just manage the warehouse. So the the e-com player will remain asset light, and the landlord, or what we call the logistic owner, would remain asset heavy. So there seems to be a clear case where people are going for asset light models, predominantly driven by the need of this technological integration, interconnection, ability to speak with multiple partners and things like that. So asset light would be the way forward.
As it seems to be in these times. So there is a question about comparing TCI and Mahindra Logistics and their businesses. I guess, Pranav, you've already gone into that a little bit. I'm not sure if there's anything you'd like to elaborate on there.
So they're completely different place. You can't compare them. Mahindra is into logistics and into transportation. TCI is more focused on tier 2 SME, MSME type of customers.
Mm-hmm.
So they are.
That's fair.
Yeah.
Nitin, you mentioned some of the regulations that have appeared recently, and I wonder, would they affect the startup players disproportionately in terms of in terms of the disclosure that they require and the structures that they sort of require?
Yeah, so definitely. So if the company is having a asset-light model, so a lot of these warehouses or the vehicles what they take on lease, now they have to show it as a asset in their books of account, right? So in a way, it looks like that they have asset-light model, but balance sheet will have all the assets. So it is going to change the dynamics of the balance sheet, how they report it. But I guess in the private, in the startups, the other impact of this particular accounting regulation is not going to be immense because these players doesn't have a lot of debt in their books of account. Right? So their debt equity ratio will not be impacted or severely impacted compared to the listed players or the legacy players.
I see. Well, this is just about all the time we have today. So I would like to thank you very much, both gentlemen, and thank you everyone for being with us today. If you have any other questions for Nitin or Pranav, please email us at research@smartkarma.com. And also you can reach out to your Smartkarma account manager. Look out for the webinar recording on the registration page shortly afterwards. And Nitin, Pranav, thank you, gentlemen, very much once again.
Thank you, Michael. It was a pleasure.